The capitalization rate, or cap rate, is a metric commonly used in commercial real estate to indicate the expected rate of return on an investment property. It is calculated by dividing the property's net operating income by its asset value and is presented as a percentage. This rate helps investors estimate the potential return on their investment in the real estate sector. Additionally, the cap rate assists in determining the exit or terminal capitalization rate of a property at the conclusion of its holding period. While the cap rate is useful for comparing the relative values of similar real estate investments, it should not be the only factor considered when evaluating an investment's potential. This is because it does not account for aspects such as leverage, the time value of money, and potential cash flows from improvements to the property, among other factors. The cap rate is a widely favored metric used to evaluate the profitability and return potential of real estate investments. It represents the yield from a property over a one-year period, assuming the property is purchased outright without financing. The capitalization rate reflects the property's natural, intrinsic, and unlevered rate of return. So what is the formula for the capitalization rate? There are various methods for calculating the capitalization rate. In the most commonly used formula, the cap rate for a real estate investment is determined by dividing the property's net operating income, NOI, by its current market value. This is the formula. Let's explore a detailed example of calculating the capitalization rate for a commercial property, taking into account a variety of expenses. Consider a commercial real estate property with a market value of $1,200,000. This property hosts a mix of tenants including retail stores and professional services, generating a total annual gross rental income of $200,000. To understand the property's profitability, we need to account for all associated operating expenses. The expenses include property management fees, which are typically 10% of the gross rental income, amounting to $20,000. Maintenance and repairs are crucial for keeping the property appealing to tenants and cost about $15,000 annually. The property taxes are another significant expense at $30,000, reflecting the property's location and valuation. Insurance costs are approximately $10,000, necessary for covering potential liabilities and property damage. Utilities, which include lighting and water for common areas, come to $5,000, while an additional $5,000 is set aside for miscellaneous expenses like unexpected repairs or minor renovations to enhance tenant spaces. Adding up all these costs, the total annual operating expenses amount to $85,000. To find the net operating income, NOI, we subtract these operating expenses from the gross rental income, resulting in an NOI of $115,000. Finally, to calculate the capitalization rate, we divide the NOI by the property's purchase price and then multiply by 100 to convert it into a percentage. Therefore, the calculation is $115,000 divided by $1,200,000 times 100. Yielding a capitalization rate of approximately 9.58%. This rate provides insight into the property's intrinsic rate of return, assuming it is bought outright without financing, and serves as a benchmark for comparing the profitability of this investment against others in the market. Now, with that example in mind, you should consider that cap rates can vary significantly. This variation underscores the importance of understanding what a good cap rate looks like for an investment property. Cap rates also show how long it will take to recoup the initial investment in a property. For example, a property with a 10% cap rate would typically take about 10 years to return the invested amount. The differences in cap rates between properties or over different times for the same property indicate varying risk levels. The formula reveals that properties with higher net operating income and lower valuations tend to have higher cap rates, and vice versa. Consider two properties identical in every way except their locations, one in an upscale urban area, the other on the city outskirts. Generally, the urban property would fetch higher rents, though this could be offset by higher maintenance costs and taxes. This property would likely have a lower cap rate due to its high market value, indicating a better valuation and lower risk prospect for appreciation returns. Conversely, a higher cap rate suggests lower appreciation return and greater risk. Although the example suggests the urban property is the better choice, real-life investment decisions aren't always so clear-cut. Investors must navigate the complexities of determining the appropriate cap rate for the level of risk they are willing to take. Hope you like this video.
Thanks for watching. Our channel is dedicated to making investing, finance, and economic concepts easy to understand, empowering you to make smarter financial decisions. If you found this video helpful, others might too, so please share it to help them benefit as well. Help us spread the word by subscribing to our channel. Let's make finance and investing knowledge accessible to everyone. And don't forget to check out our website at www.investingcouncil.com for more information and resources. See you next time.